Welcome back to the deep dive. You know, if you thought the end of Q3 earnings season meant things would quiet down, well, think again. We just ran a really massive and diverse stack of sources covering U.S. stock activity over the last 24 hours. That's November 10th into the 11th, 2025.
Yeah, it definitely wasn't a day packed with those major 8K filings, the big unscheduled material events. That's pretty typical for this kind of post-earnings quiet period.
Right.
And this is crucial. This is often where you find some really critical signals hiding. Like the leftover analysis, the unexpected regulatory stuff, and those subtle insider moves that kind of hint at what management's really thinking.
Absolutely. So our mission today is really a rapid-fire distillation. We're looking at key analyst moves, Form 4s, Form 144s, unexpected news, and across a huge grab bag of sectors. We've got fintech, health tech, prop tech, retail, media. We're looking for that critical nuance you need to know, and fast.
Exactly. Because when the big earnings reports stop flowing, the focus shifts. It goes entirely to, well, the underlying sector mood and maybe catalysts that aren't specific to one company. So we're tracking shifts related to how the market's still digesting Q3 results, those insider intent to sell declarations, and any external regulatory changes that could hit consumer markets.
Okay, let's unpack this right away. Let's start with what seems like the most significant positive news in our stack. And it centers, maybe unexpectedly, on health tech, specifically Hims&Hers Health, ticker HIMS.
Right. The catalyst here, interestingly, wasn't from Hims itself. It was actually about a potential regulatory shift at the FDA that hit the news wires.
Okay.
Apparently, the FDA is planning, or reportedly planning, to remove the black box warnings on menopause hormone therapies, MHT.
Okay, now here's where it gets really interesting for me. Why does a specific regulatory change about MHT matter so much to a big direct-to-consumer health company like Hims?
Well, because Hims just recently entered the market for treating menopause symptoms. And those black box warnings. They're basically the strongest cautionary statement the FDA can issue. So relaxing that, removing it, it drastically cuts the perceived risk for consumers.
Makes sense.
Yeah, and dramatically increases accessibility. So this could immediately expand Hims' potential market significantly.
Yeah.
It's a totally unexpected external positive catalyst. Has nothing to do with their quarterly sales figures.
But as we always seem to find, there's maybe a dual signal here, because alongside that great regulatory news, Hims also saw Form 144 filed. That was November 10th.
Yes, that Form 144 filing is key. Because remember, that's the declaration of intent to sell by an insider or a major shareholder.
Right. Not the sale itself, but the intention.
Exactly. It doesn't mean the stock sold today, but it signals they're preparing to sell shares probably within the next 3 months. Now, often this is just, tax planning or part of a scheduled 10b5-1 plan. But seeing an insider flag, potential profit taking, right next to a major positive regulatory development, that's definitely important context for you to have.
Noted. Definitely noted. So we saw those signals for Hims, but the other health tech names we tracked, Teladoc, tdoc, and Doximity, DOCS, the news flow seemed much quieter.
Precisely. Both were basically silent in the last 24 hours. No new material announcements, no 8Ks. Their news is still all about the analysis and the market reaction to their Q3 earnings reports from, a few weeks back now?
Right.
The market's just kind of settling after those results.
Okay, so those names quieted down. That brings us nicely to where the market is still, as you put it, kind of chewing on last week's results, particularly for media and learning companies. Let's start with the streaming fight. FuboTV, FUBO, and Roku, ROKU.
Yeah, and what's fascinating here is how even when a company reports a seemingly great quarter, the market can be pretty ruthless. It tends to focus entirely on the forward guidance, the future strategy, not really looking in the rearview mirror.
Okay, take FuboTV then. Their Q3 results, November 3rd, they beat Wall Street on revenue and earnings. And they even hit positive adjusted EBITDA for the second quarter in a row. By the numbers, that sounds excellent.
It is, objectively. But recent analyst reports, even ones from like 14 hours ago in our sources, they focused on market cautiousness.
Why the caution, then?
Well, part of it stems from the general competitive scene, especially that Hulu plus live TV merger looming. But FUBO management is making strategic moves in response.
Like what?
Well, they talked about using AI for marketing optimization. Apparently, that's actually improved conversion rates from free trials, which is good. Plus, they just launched the Fubo channel store.
Ah, right. Allowing non-subscribers to buy individual channels.
Exactly. It's a new monetization path the market's still sort of evaluating.
Okay. Meanwhile, Roku, which also had pretty solid earnings recently, its stock actually dropped about 2.4% on November 10th. What's behind that sort of negative delayed reaction?
That drop, it's very likely a lagging effect from earlier news. Specifically, insider stock sales, those Form 4 filings reported around November 4th.
Okay.
Insider selling can sometimes have that delayed, dampening effect on sentiment, but you've got to see the other side too.
Which is?
We also saw a 13F filing showing that major institutional investors like Connor, Clark, and Lund, for example, were actually increasing their stake in Roku, buying into that dip based on the Q3 performance.
Wow, okay, that's a perfect example of really conflicting signals then. But maybe the most intriguing post-earnings story we found has to be Duolingo, DUOL, a 25% stock collapse after reporting stellar Q3 user growth. They hit 50 million daily active users for the first time. That just feels odd. What are investors punishing them for?
This really raises a big question about immediate versus long-term investor priorities. The analysis strongly suggests the drop was due to investor frustration.
Frustration about what? The growth was good.
About the company's strategic focus. DUOL made it really clear they're prioritizing long-term user growth and the health of their ecosystem. And they deliberately chose to delay aggressive short-term monetization strategies.
So they want the money now.
Pretty much.
Yeah.
Investors, especially maybe those chasing quicker returns, seem to be punishing the company because they want that monetization engine flipped on now.
Yeah.
Even though the underlying user metrics look really healthy.
That's a powerful lesson in, valuation friction.
Right.
Okay, let's shift gears. Move out of media and into the competitive retail space. Let's focus on that growth versus value dynamic between, say, athletic footwear giants On Holding, ONN, and Deckers Outdoor, DC, the HOKA parent.
Yeah, this specific competition is a fantastic case study in market valuation friction right now, especially with On Holding heading into its earnings report this week.
Yeah.
The market seems completely torn.
How so?
Well, just look at the analyst moves right before ONN's report. Truist lowered its target price from $69 down to $60, but they kept a buy rating. Their reasoning cited concerns about a U.S. growth slowdown and, the general market mood avoiding high valuation consumer stocks right now. But the sentiment is totally fractured.
Fractured how?
Jefferies has an underperform rating with a $40 target. Morgan Stanley. They're maintaining overweight at $65.
Wow, that is a massive spread of opinion, especially as you said, ON is trading near its 52-week lows. Now, Deckers Outdoor comparatively seemed quiet over the last 24 hours.
Yes, it was quiet. And that quietness actually gives us some crucial context here. There was some AI analysis cited in our sources that provides a real aha moment when you compare the valuations of these two.
Okay, lay out that comparison for us.
Right, so Deckers with HOKA and UGG, it's trading with a price-to-earnings PE ratio around 12x, and it has a very high return on equity, ROE, of 43%. That puts it squarely in the value stock category right now.
Okay, 12x PE, high ROE, value.
Got it. On Holding, on the other hand, is still very much classified as a high-growth stock. It's trading at a PE ratio around 76x.
76?
Yeah.
Wow.
Yeah, and its ROE is only about 9.6%.
Right.
So the market right now is really punishing those high multiple growth stocks that show any sign of a slowdown, which perfectly explains the deep volatility around ON despite its obvious brand strength.
That structural comparison makes the nervousness from Truist and Jefferies make a lot more sense. Okay, moving quickly to other retail names. Wayfair, W. They saw a positive analyst report.
Yeah, citing two key improvements. Better logistics, specifically through their Castlegate network, and also the strengthening of their exclusive brands that resulted in a target price upgrade. And they also just released their new holiday season marketing guide trying to spur sales.
Okay. And Lovesac. Love you.
Lovesac, we just noted a recent Form 4 filing. It looks like pretty standard stuff, probably restricted stock unit vesting or maybe a stock option exercise for an executive. That came alongside a neutral Zacks hold rating. Nothing too dramatic there.
Okay, let's try and pull all these insider signals together now and maybe transition into fintech and prop tech. It really seems like those Form 144 and Form 4 filings, the intent to sell or actual transaction signals, were a major feature across several different tickers today.
They absolutely were. We saw them for Hims, Lemonade, LMND, Robinhood Hood, and Lovesac Livery Day just in this batch. It definitely suggests that across multiple sectors, insiders are actively looking at their holdings, maybe capitalizing on recent market moves.
Let's focus on Lemonade for a second. LMND. They had a big jump recently after earnings, right?
They did. And Morgan Stanley raised its target price from $45 to $49. This followed what the co-founder called a company history best Q3, where they significantly cut their net loss.
So good news there.
Yes, but again, that dual signal is critical. The analyst target price raise confirms momentum. That's positive. But the simultaneous Form 144 filing on November 10th strongly suggests insiders are likely getting ready for some profit-taking after that recent stock jump. It kind of reinforces the cautious underweight rating Morgan Stanley actually maintained, even while raising the price target. These filings often precede cashing in on a quick rally.
Right, okay. Now, for the prop tech and real estate sector, we looked specifically because a listener asked, at Zillow, Opendoor, Rocket, Compass, AppFolio, and CoStar, you found something kind of unique in just the absence of news there.
Yes, exactly. All 7 of those companies in PropTech and related areas had absolutely no significant news or SEC filings in the last 24 hours. 0.
And that tells us...
That's the definition of a lull. It tells us that without major Q3 results hitting the wire or large immediate M&A events, the kind of stuff that triggers an 8K filing an entire sector can just enter this post-earnings holding pattern, where things are basically running as expected, good or bad.
So the absence of a filing can be just as telling as the presence of one sometimes.
Precisely. If nothing material enough to report happens in a 24-hour window, especially right after earnings season, it often just means the underlying business is maintaining its course, for better or worse.
Okay. Our final sweep then showed Celsius, CELH, saw a sustained drop, nearly 8% on November 10th. That looks like a continued negative reaction to their Q3 earnings miss from a few days ago.
Yep, market's still punishing that miss.
And meanwhile, Oatly, OTLY, BellRing Brands, BRBR, and Dutch Bros, BRS, all had basically no significant 24-hour news, just silence.
Total silence.
Okay, so wrapping up this deep dive, I think the key lesson for you, the person listening and trying to track these trends, seems clear. Even in a supposedly quiet news period after earnings, the market is sending critical signals if you know where to look. We found regulatory boosts that kind of defy expectations, like with Hims. We saw that post-earnings strategic digestion causing investor confusion, like Duolingo getting penalized for its priorities.
Right.
And we highlighted those competitive valuation shifts, seeing that stark contrast between high growth like Onan and high value like DIC.
Absolutely. And maybe if we connect this to the bigger picture, given these mixed signals on growth versus value and that definite uptick in insider sale intentions we saw today across different sectors, it raises a question.
Which is?
How much weight should you as an investor really give to a single-day analyst upgrade versus, say, the underlying competitive health and the structural valuation story of an entire sector?
That is a question definitely worth mulling over until the next 24-hour cycle kicks in. That's all for this deep dive into the market's undercurrents. Keep seeking out those critical nuances behind the headlines.